Banking sector underwater. Fed bailouts coming. Let's get into it. Hello, this is Chart GPT today. We're going to look at the banking sector. We've got a lot of charts here. We're going to go through it fairly rapidly, but it kind of gives you the feeling of what's going on in the banking sector, because it does kind of indicate the health of the economy going forward here, coming up in this critical 2024 season. Let's take a look. Here's all the banks. You can blow this picture up if you'd like to see what the state of the banks are in terms of assets. Obviously, we have the big four, and the rest are just kind of also-rans. But if you combine them together, they could add up to quite significant amounts. First off, we'll take a look at the loan growth, and it's actually falling off a cliff here, and I'm sure that's what the Fed is looking at. The economy is slowing. A lot of predictions of recessions ahead, and of course, this is one big factor of that. Looking at the amount of cumulative growth for loan growth in U.S. banks 2023 versus 2022, and of course, it all kind of stemmed from the SVB collapse earlier in the year 2023, and that's still ongoing, believe it or not. The Fed has been doing some rescue attempts already. So we talk about bailouts, they already are kind of in process. Here's the another way to look at this decline in bank lending. So banks are not loaning, and of course their requirements to get a loan are much tighter. So there's that. Of course, this is the same story in Europe as it is in the United States, and pretty much mirror, because central banks work together on all this stuff. With people getting nervous in the rate differentials, people are bailing out of the deposits, so deposits are fleeing the banks quite rapidly. So that's going to affect their capital ratios. Here's the credit card delinquency rates. They're rising, not as high as 2008, but they're in the upward direction. We'll see how that goes over the next few months here going into 2024. Auto loans are in serious delinquency. They're near 2008 levels, so the auto sector is going to be under pressure as well, considering how these loans are being harder and harder to get, and they're very expensive. With the rise of the federal rates, of course, the federal discount rate, you can see that the credit card rates are at pretty much recent all-time highs, around 23%. That's outrageous, and that's going to eat into the consumer's pocket. Looking at some delinquency rates for different kinds of loans: retail, regional malls, multifamily, hotel, office. So, you can see they're off the charts, especially that retail and regional malls. So the banks are going to have to suffer. We've heard all about the office vacancies. So, of course, this means declining business. Here's that discount loan versus the BTFP loans. The BTFP loan was given for the SVP to bail out the banks, and people are running to get that. There's some rate differentials. That's why they've been kind of going up a little bit. But that's set to expire in March. Will the Fed continue that or not? That'll be an interesting thing. Another headwind for banks to worry about. Here's the unrealized losses. They're up close. They're approaching what, $3/4 of a trillion. These are the losses on their loans that they have yet to mark the market. We've heard this story before, back in 2008. Could this continue to rise? It's going in the wrong direction. Here's another way to look at it. It's 30% of bank equity capital, meaning 30% of their equity is smoke and mirrors, basically. So how does this all translate into the performance of the banking sector from a stock perspective? You can see they've been way outperforming, or underperforming rather, the S&P. Of course, they've come up recently since November because of the rate reductions, because that'll probably help the banks to survive what's coming. And of course, what's coming, the World Bank had a statement out in the last day or two where they're saying the global economy is set for the worst half decade. I guess that's 5 years growth in 30 years. That's a pretty big statement. As much as a percent, a lot of people don't think a percent's a lot, but it is huge in terms of what it'll feel like on the street as economic hard times are a-coming. What does that mean? Well, here's one prediction from Morningstar. You can take a look at the description box and the post link. Hear this interview from Morningstar, basically saying they're predicting 6 rate cuts, which puts it down around the 3% mark. Now, our prediction has been out for quite some time, over 6 months, more than 6 months, in fact, because we thought that the Fed rates, the economy will suffer and the rates will come down. Maybe not as quick as this chart shows, but this is what we've had, and I'm just going to stick to the chart that we put out. But we're thinking it's getting down maybe 2.5. Of course, Morningstar is saying around 3. Many of these rate cuts will come. We'll see if that happens or not. In any case, we look at the AI and tell you what the 5 top things that you need to look for in terms of bank health. and take our online poll. Will we see a banking crisis unfold in 2024? Or will the Fed come in and rescue it? Well, they already are. Will they come in and rescue it in a more significant way? Is the storm clouds building? Will we see this? These charts don't look good. We'll see what happens. In the meantime, don't forget to subscribe.